big money is buying Bitcoin, while most people are worried. And what's interesting isn't just that they are buying, because when prices fall, retail usually panics. But large investors often do the opposite. They buy slowly on the way down. They're not making a big show about it. They're not reacting to every price move. They just keep buying bit by bit over time. Nothing dramatic, just steady. And for them, a crash doesn't always mean disaster. Sometimes it simply means buying cheaper. Hi, my name is Lamia and I create this video about crypto, blockchain and how regular people can understand what's happening in the financial world without all of the noise. Personally, I use dollar cost averaging myself. I buy slowly over time instead of trying to guess the perfect price. When market crash, I don't automatically see danger. I often see an opportunity to buy at a lower price, as long as the long-term idea hasn't changed. In this video, I want to explain something simple but really important. Why most big players accumulate during drops, why dollar cost averaging works for many people, and the mistake that keeps a lot of investors stressed instead of steady. Let's start. Recently, large entities increased their Bitcoin exposure by hundreds of millions of dollars. But they didn't do it in one huge purchase. They did it step by step. That's what dollar cost averaging is. You buy fixed amounts at regular intervals, no matter the short-term price. Up, down, sideways. The goal isn't catching the perfect bottom. The goal is building a position over time. And when price drop, you're simply buying the same assets at a lower cost. Many people try to time the market. They wait for the perfect dip. They wait for accumulation. They wait for confirmation. They wait until it feels safe. But when it finally feels safe, the price is often already higher. Dollar cost averaging removes a lot of that pressure. You're not predicting every move. You're just participating constantly. It's not about getting rich quickly. It's about building exposure slowly. Trading can work, but it requires skills, time, and discipline. For most people, a long-term approach is simply easier to manage. When markets drop suddenly, a long-term investor doesn't panic as much because their plan hasn't changed. They're not reacting to every candle. They're following a system. Another point many overlook is ownership. Keeping Bitcoin on an exchange isn't the same as holding it yourself, and I always repeat this. Exchanges are companies. They have rules, limits, and risks. When you hold your own keys in a hardware wallet like this, you have direct control. It's not about fear, it's about understanding how the system works. No one knows the bottom. You'll always hear predictions. Bitcoin will never drop below this. Bitcoin is going to zero. Bitcoin is going to the moon. The truth is, no one knows the exact bottom. And if your strategy is consistent, the exact bottom matters less than people think. At the same time, global debt is rising, currencies are changing, and digital assets are becoming more common. Whether someone fully believes in crypto or not, the conversation is no longer small. It's becoming part of the financial system. So the real question isn't, did I buy the perfect dip? The real question is, do I have a plan? Or am I just reacting? Because in markets, consistency often matters more than timing. And preparation is usually quiet. It's just discipline over time. Thanks for watching and I'll see you in the next one.